So we're still waiting for that key data. If that key data actually misses and we hit higher than expected CPI in August, that will be negative for the market and we'll likely see a negative reaction. So what are the levels that we're looking for? On a hawkish CPI, we expect a sell-off all the way back down to 440. On a bullish CPI, we expect these highs to be taken out and a gap fill at 456. Welcome back, you legends. That was a recap from yesterday's key outlook heading into one of the biggest, most important economic events this year, and that's the CPI print coming out tomorrow morning at 8:30 a.m. Eastern Time. We expect the Bureau of Economic Statistics to actually release a second increase in inflation year over year. Last month, we had inflation rise from 3% to 3.2%. This month, or I should say for the month of August, inflation is expected to rise yet again to 3.6%. That's the consensus, albeit core inflation is expected to decline from 4.7% in July to anywhere between 4.3 and 4.4% for the month of August. Now, let's take a look at the trend of inflation. This is headline inflation, CPI, going back all the way to August of last year. Notice, legends, we've been consistently moving down. We had a couple of upticks, but mostly we've been trending down, and this trend is expected to continue with headline inflation coming out anywhere between 4.4 to 4.3% below the July reading of 4.7%. I misspoke there, legends. This is core inflation, not headline inflation. Headline inflation, on the other hand, which is more volatile than core inflation, again has been consistently going down with the exception of July. The last reading was 3.2%. In August, it is expected to jump to 3.6%. That's the consensus. And we'll soon get into that. Now, I put out today, before the market opened, a note explaining my personal outlook on CPI, both core and headline. I outlined the consensus, the trend, and my own personal expectations. Now, consensus is headline will be higher, core will be lower. However, if we look at the Fed nowcasting model, look at this, legends. Core CPI is expected to be 4.46%. That's rounded up to 4.5%, and that's above the consensus. The headline number, again, look at this, legends, 3.8%. Yet again, that's above the consensus of 3.6%. So this is looking like it's going to be a really hot number. Now, I don't trust the Fed nowcasting model, and I don't trust the consensus. The Fed nowcasting model tends to overestimate inflation when it's declining and underestimate inflation when it's rising. So we don't like to use it all that much. My personal preference is actually to look at the forecast of Stephen Anastasio. Now, I've actually looked at his previous forecast, and so far he's been right on the money. I was tipped by one of the legends in the community to his work about a couple of months ago, and I looked at his previous forecast, and he has so far been more accurate than the Fed nowcasting model and more accurate than the consensus. He's forecasting 3.7% headline, which is above the 3.6% consensus. So what does that mean, legends? Well, we have the Fed nowcasting model and we have preferred inflation forecaster, both forecasting inflation above consensus. Okay, so let's game plan this out. I discussed in the last video the two key levels that I'm watching for both a hot CPI and a cool CPI. In fact, I shared this chart today with the legendary trading community to discuss my personal outlook based on all the data that's available to us today. And based on that data, we can form educated forecast for both scenarios, a cool CPI and a hot CPI. Now, for a cool CPI, we expect the market not only to fill the gap at 449, but to move even higher, take out these prior highs at 453, and fill the gap from early August at 456, and let's say 2 to 3 trading sessions. In case of a hot CPI, I expect an immediate sell-off, all of these recent lows to be taken out, and for a new short-term low to form at 440 to tag this support line. I also expect the PPO to turn back down, form a higher low as the market forms a lower low in the short term. On the 1 hour chart, it looks something like this, with a lower low as the PPO actually forms a higher low. Now, very interestingly, today the market opened lower. It still opened above this key blue moving average. It rallied again, filled this gap from yesterday. However, it came short yet again, filling the gap at 449, about 20 cents short. The market tried twice to fill this gap. It failed twice. It went back down and closed right at this low moving average. So we've now formed one higher low, two higher lows, three higher lows, although we have failed to make a higher high. Now, this is the note that I put out Monday morning to open this week. This is what I had to say. On the SPY 1 hour chart, I'm looking for a gap fill at 449 ahead of CPI. We almost got there, legends. We were 20 cents short. I'm keeping an open mind with regards to CPI, but I don't expect outsized moves until after the data is released. So we could fill the gap at 449, pare back those gains, give back those gains, and basically move sideways until Wednesday morning. Now, if we look at the weekly chart, that's almost exactly what we did. Look at this, legends. We're pretty much back at the closing price of last week, just a few cents above. That's exactly what happened. We had a rally Monday. We almost filled the gap of 449, came very close to filling it, did not manage to do it. Then we gave back those gains and closed right above key support at 446. This is the key short-term support that we have from our moving averages, which are still inclining, but we do have a major event tomorrow, legends, and that's CPI. And based on the data that I'm seeing, I do believe that CPI will surprise the consensus and come out hotter than expected. Based on that expectation, I think the market will sell off and move down to 440. At least, in my opinion, at least 440. If we hold 440, I think that will be the bottom. We will form a double bottom with a lower low on the hourly charts and a higher low on the PPO, establishing a double bottom with a bullish divergence on the hourly chart. That is assuming we hold 440. If we break 440, I think we continue lower to fill the gap at 431. This gap has not yet been filled. It remains from late June. We tried to fill it on the August 18th bottom. We could not get that job done. And so I think if we break below 440, we go lower to 431 and form a double bottom as well on the daily chart. Something that looks like this, especially heading into the Fed meeting on September 20th. And I think at that point, the market will have completed this huge, massive bull flag. And I believe that sets us up for a monster rally as the market has been coiling for months and months. So just a very quick recap, legends. I want to keep this very short and simple so you guys can plan out tomorrow's moves. The daily expected move for tomorrow for CPI day is actually 449. It's actually 449 to the upside and 443 to the downside. That's the expected move. The 2 sigma move, and I do believe we'll probably see a 2 sigma move tomorrow. 2 sigma moves basically, guys, are 2 standard deviations outside what is normally expected. And I do believe the market will move 2 standard deviations beyond the expected move tomorrow because I think CPI will surprise. If CPI meets expectations, then a 1 sigma move, a standard deviation move, is more in line with what we should expect. That means 449 to the upside, 443 to the downside. A 2 sigma move actually puts us at 439.8 and 452 to the upside. Now that's very interesting. Why is that? Well, because the 1 sigma move basically puts us in this range between the gap up above at 449 and the low from last week. The 2 sigma move puts us between, again, look at this, legends, between the resistance line of this bull pennant and the support line of the bull pennant. So it's not a coincidence. It's kind of funny how everything lines up, but they line up perfectly. What are my personal expectations? I think CPI will surprise to the upside, meaning it will come hotter than expected, and I think the market will see a sell-off to 440. If we hold at 440, I think the market will form a bottom there. If we break 440 and if we close below this support line, I think we continue lower to 431 into next week after the Fed meeting. In fact, legends, let me forecast this for you precisely how I think it's going to play out. This is just my personal opinion. This is kind of what I think it's going to play out. I think the market will gap down, open at 444, continue lower to 440, then basically move sideways, something that looks kind of like this, hug the support line, then break the support line, move all the way down to 431 by the end of September. That's kind of my current expectation based on what I'm seeing from CPI and based on what I expect the Fed to do in the September meeting. I think they will hike rates one final time. And that's why I expect the big move tomorrow to be to the downside, then nothing, pretty much just hugging, trying to recover, hugging the support line, then breaking it, moving down, filling the gap of 431 in September. This is based purely on the assumption that CPI will surprise and come hotter than expected. If CPI meets expectations or actually come lower than expected, I actually think the market will gap up, open at 448, then continue up and close and rally all the way to this resistance at 452 heading into next week's Fed meeting. Again, legends, take a screenshot of this if you need it. This is my personal forecast. I think on hot CPI, will go down to 440, even 439 tomorrow. On a cool CPI, I think we rally to 456 and above by the end of the week. Very short term based on the CPI forecast from the Fed nowcasting model and my own preferred CPI forecaster. I lean towards CPI coming hotter than expected. Now, legends, please pay very close attention to what I'm about to say. The S&P 500 200-day breadth chart is showing us something absolutely fascinating. And it goes against a lot of what I just said. And I have to share this because it's very important. I do want to share everything that goes against my short-term forecast and everything that supports my short-term forecast, okay? I'm honestly not married to any one outcome. I'll trade the market no matter what, up or down. We can make money either way. So what is the breadth chart showing us? Well, breadth today, the 200-day breadth today went up. It is up. It actually closed above the 5-day moving average. What did the S&P 500 do? It went down. The S&P went down today and breadth expanded. Not only did breadth expand, it is forming a double bottom with a lower low and a double bottom with a higher low on the PPO. This is one of my absolute favorite bottoming setups. A double bottom with a lower low on the price action and a higher low on momentum. It's a double bottom with a bullish divergence. Breadth is actually telling us no matter what happens with CPI, that we're likely now forming a major bottom. Means even if the market sells off on CPI, we are still likely to form a major bottom in the next 5 to 6 trading sessions. That is between now and post-Fed meeting on September 20th. Why does this double bottom matter? Why does this divergence matter? The percent of stocks in the S&P 500 trading above their 200-day moving average, that percent went up today, even though the S&P 500 is down, even though the S&P is down half a percent. Why? Well, because that 0.5% decline was led by a handful of huge companies: Amazon, Tesla, Google, Meta, Microsoft, Apple, Nvidia. You can actually draw a line down the middle and you can see the vast majority of stocks in the S&P were either flat or up, and a handful of large companies were down. So even though the market is down, breadth is actually improving. So how can we reconcile breadth and the market likely selling off today? The way I'm looking at it is that even if actually breadth continues to move down, makes a new low as the S&P moves lower, I think breadth will continue to form this double bottom with a bullish divergence, and I don't think it will change much. But a huge, big question mark remains around that Fed meeting next week and whether we will hold this support line or whether we will break it. We'll have to revisit that when it happens. After we tag this support line, we will have to revisit again. If it holds, this huge, massive, humongous bull pennant will remain intact. But if it breaks, we almost certainly will continue lower to tag this major support line that tagged every single major bottom throughout this uptrend since October of last year. But again, legends, we need a huge fundamental economic driver to actually tag this support line. Why? Well, because the last time we tagged it, the banks were collapsing, regional banks were collapsing, SVB went bust. The prior time, inflation was actually at its highest in decades. This was the highest inflation read in decades. So we need something huge. We need something big to tag this. Could that be the rate hike coming up in September next week? Possibly. We will have to wait and see. Let's close this out with the VIX. The VIX has not yet filled this gap at 13. That remains a possibility. I'm still waiting for that gap to be filled. It hasn't yet. What could happen if CPI is hotter than expected? I expect the VIX to rally again and potentially yet again get rejected at the 50-day moving average as the S&P 500 moves lower and potentially tags this support line at 440. If you found value in this update, smash that like button, slap it right in the face. And if you watched the video till the end and you did not enjoy it, I thank you for your time and attention. That's all I have for you today, legends. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow.